Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody, and welcome to the Aftermath. Yes, yesterday, pretty big jump in interest rates yesterday, despite nothing really new or interesting in the press conference. But the phrase that the traders seemed to pick up on was when Powell said, we are a long ways before rising interest rates affect employment. And that wasn't his exact words, but it was something to that effect. And it was almost like, I think one of the problems that I have is I follow the interest rates and what's going on and what the Fed speakers say very, very, very closely. And not everybody does. And there's been a lot of people with this idea that, well, but the Federal Reserve isn't going to do anything to hurt employment and they're going to keep the Ponzi scheme propped up. And when he said that, I think that was finally the thing that made these guys realize that, oh no, they're going to tackle inflation first because that's their primary mandate. So interest rates did rise. We may see that pull back, though. I think that we shouldn't read too much into the FOMC. The daily action itself, let's see how it goes. And we might see some flows today that we could, ride. We are seeing, here is the 10-year, so you can see 10-year like really just got creamed. But they did not get to the lows of the year. Not yet. We could see a test of that. And that would be an interesting technical battle. But I also think that we may see some retracement of this. And especially here in a minute or two, I should actually come out here because we've got, actually, I'm a lot later than I thought. You know what? It kind of was difficult to get things started. How are you guys doing, by the way? Okay, so here we get U.S. initial jobless claims and U.S. core PCE prices. So the estimate is 4.9. If we get above 4.9, look out below. Look out below, folks. All right? Because that is like the Fed's favored metric. And and also, I mean, initial jobless claims last time around were not particularly good. We're looking for a reading of 265K on that one. All right, so we got about a minute here. Do I have time? No, we'll wait. We'll go through do the rundown after the news.
1 minute to go now. I'll be reading the US GDP quarter over quarter advance first.
I don't know what it is that I'm allergic to that makes my eyes water, but it really drives me crazy. It really drives me crazy. I want to know. Should go see an allergy specialist. Well, I can see the E-mini kind of doing some funky things ahead of the news.
Ten seconds.
Okay, so I'm getting here
6.9%, 6.9% higher than the forecast of 5.5%. US initial jobless claims.
US GDP was a lot higher than anticipated. Initial jobless claims about in line, 260 versus 265. I'm still waiting for those core PCE prices, though.
Core durable goods, 0.4%. 0.4% higher than the forecast of 0.3%. The US continued jobless claims, 1.675 million, 1.675 million. That's That's higher than the forecast of 1.652 million. US core PCE prices advanced.
Okay, core
4.9%,
PCE prices
4.9%
came in
with the
line.
forecast of 4.9%. We have the US net.
So
retail
we are
export
getting
sales
some
coming out at
movement here, but
676.7K,
I don't want to take a trade immediately off of that.
US net
Let's let it
soybean
sit here.
export
I have a
sales,
little bit of food. I'm going to take a bite or two here for a second.
1,025.500K,
Snarf this oatmeal down real quick.
1,025.500K. US GDP deflator advance 7% higher than the forecast of 5.9%. US net corn export sales 1,402.4K, 1,402.4K. So just looking at the markets after that release, not seeing too much movement on any of the indexes here.
What a mistake buying an oil equity while Powell was talking.
US GDP.
What are you talking about? Oil is up.
2021 and the US initial jobless claims full reports are now both available on the.
I would, hey, when the market's open, it'll be okay. It'll be okay. I mean, it's probably down because equities are down, huh? But oil still up. You know what though? OPEC next week. OPEC next week. I'm still kind of waiting on oil. I don't know if I want to make the mistake I did last time, trying to trade ahead of that.
So the US PCE prices advanced here, coming out at 6.5%, 6.5%.
Did you see the gap yesterday? The data was removed from my data feed, CQG. I'm not sure what you're talking about, to be honest. There was all sorts of gaps in the ES, though. And they were very useful, but ultimately it was a downtrend, so... I tell you, that gap, and I have it in my indicator package now, if you go to speculatorseth.com. Available for a one-time fee of $100, but you can try it for 2 weeks. And it is the most reliable technical indicator I've ever seen. Of course, what it's telling you is that price is probably going to rotate around that spot for a little bit, but it is the most reliable technical signal I've ever seen. Well, I don't see anything funky on my 5-minute chart at that time, but I'll have to take your word for it. You like delta divergences? Well, I've always really paid attention to cumulative delta. So here's the thing. Let's get into the empirical evidence of this sort of a thing. Okay. Orders are actually way more predictive or are way more predictable than you might think. So there is a pretty strong autocorrelation effect when it comes to orders. So if you see a market buy order out there, you are 0.5% more likely to see another market buy 1,000 orders from now. Like, that's the degree of which there is an autocorrelation effect with orders. And there's a couple of theories about why this happens. And one of the first theories, or at least the technical analysis view of this, would be that autocorrelation is caused by herding effects, that everybody sees that somebody is buying, and so they try and buy themselves, and it's kind of this self-reinforcing behavior, right? And so there are ways to model this sort of a thing. And so when scientists tried to model that sort of a thing, they had a hard time arriving at the kind of market behavior that we actually see. You're getting a preview of what's going to be on Monday's video, by the way. Okay, so they started looking at it from other approaches, and one of the approach was that it was due to large institutions executing trades over a long period of time. And when they went and they did the modeling on that, those models matched actual observed market behavior more closely. So the leading theory for what causes autocorrelation effects in the market is the existence of large meta orders. Okay. But what happens is the market makers account for that. So even though the orders themselves are very predictable, the market makers change their prices and so forth so that the effects of those orders are largely diffusive. And so you end up with this thing where you can predict the orders in the order flow, whether they're going to be a buy or a sell with the autocorrelation effect, but you can't make the same prediction in what the price is going to be. So you can't come in and say, well, generally overall they're buying it, so I want to buy it too. And then it goes, that tends not to work because of market making, basically. So when you're looking at cumulative delta, right? Cumulative delta is telling you, hey, there's buying or selling in here, right? And so when I look at a cumulative delta, and part of the reason why I like to have it up there is I say, okay, there was a sell meta order here. Then there was the news. Now we're flat. They're not doing anything right now, right? maybe we get another sell meta order. Maybe the sell continues, right? But you got to be careful because when you look up over in here, look at this. The cumulative delta is all down, but look at all the troughs and the price is largely diffusive across this range. So you couldn't have said, "I'll just sell it," unless you caught the top of that range, right? The other issue is that particularly in the S&P 500, because it's a hedging instrument, so you will from time to time get these periods where you will see the futures trade very aggressively one way and price go exactly the opposite. And I haven't found any way of being able to tell when that happens. So coming in and saying there's a divergence between price and cumulative delta, and therefore I want to take a trade, it doesn't work. I've traded that way myself for a long time. What indicator did you mean? Can you show it? Yeah. Okay. So it's called, if you download the latest version, it was not in there like a few months ago, but I put it in at the beginning of the year. Okay. And it is called SPS pulled prices. And what it means is that they traded through a price without trading any volume at it, or you can kind of set it and say, if they trade like one lot in there, then it doesn't matter, or you can set a threshold. But essentially, it's a price where market makers pulled all of their liquidity and they traded across that price with almost no volume. Okay. So do you see here, for instance, in the 5 years? So when it does it, it draws one of these rectangles with the rectangle where it started from. And I did it like that because what they tend to come back to it. So you can see here was the news, then they stabilized and they had a little move down, and then they started getting these bull prices again. And look what happened. They went back and forth along here. Like, look, here, all in within that 5-minute bar, those were all pulled prices. And as soon as it happened, for the next 20 minutes, they were stuck in that range. So when I say it's like one of the most predictive things I've seen, it's totally, I mean, pulled prices like that during normal action is relatively rare. But if you see one, if I'm in like a position and I was kind of thinking about taking profits anyways, like it was kind of getting into my area or the amount that I typically tend to make, and then I see one of those, I take it off. Take it off immediately. Because what does it mean? It means that we're going to be stuck in that spot. It's a liquidity hole, right? And a liquidity hole means that there's not going to be a whole lot of buy or sell limit orders across this range, but you go above it or below it, there's going to be more. And so it kind of traps price in that location. It's like a hole, and they like fall back into the hole over and over again. This is a proven property of markets, and we were able to develop an indicator that can identify one particular situation where that can happen, where you can predict essentially that price is going to be held back. You've never been able to get that indicator to work on bonds and treasuries? Yeah, I haven't really tried using it, but what I would be doing is, so if you come into the settings of it here, SPS pulled prices, there's this allowed volume. So if I was doing it in the 10-year, I would probably put like allowed volume at like 400 or something, right? That would mean that if it trades through a price and only 400 traded there, then it should draw it. Well, it's only in NinjaTrader right now. Could you get it in Trade of 8 in the future? Maybe. Right now, you guys keep asking me these kinds of questions, and I'm just my strategic decision right now is that I'm spending the extra time making videos. And at some point this year, Jigsaw should be coming out with other features. I don't know what they are, but they appear to be some features that we might be able to make some stuff out of. And so I will make whatever it is that I can for Jigsaw. And then once I get all of the content, the video content done that we want, or the channel is having, grows to where we want, then I will probably turn around and start trying to make the indicators for other platforms. Because I don't necessarily plan on being, even if 400 never draws, really. Actually, if I can get it to draw. You are going to need tick replay turned on, right? So let's see if I can get one. Certainly, we should be able to find one from yesterday, right? Data series. So get to 5 days. Yeah. Tick replay. Yes. Let's turn it to a 5-minute chart just so that it's easier to see. We can see more. Okay. And then I'm going to come in and add the indicator. I feel like using options during liquidity holes could be extremely interesting. Well, I don't know. I've never had a feed where I got that detailed of information from options to be able to know what they would do in those areas. So let's say allowed volume 400. Yeah, it drew one. You see it? right at the very, very beginning, it drew one. Then it drew one right there. It's really hard to make it happen in the treasury, I have to say. It's really hard to make it happen. The higher you put that number, the more likely you are to see it, right? Like if we changed it up, so if we change it up to like 1,000, because that happens all the time. 1,000 apply. Should get more of them. No? Really? Was that active of a day yesterday? 2,000? Let's see here. Oh, I have to change the indicator to tell it to print them out to the window. Don't I? Print output. Yes. Hmm. You see here? Buy. So there was only 2 lots at that spot, 133 lots at that spot, and they skipped 2 prices, 3 prices, 2 prices. I think part of the problem is that it has to be like 2 full prices, and that like almost never happens in the treasury. Probably would be more likely to see it in well, let's just do ZB. Let's just do ZB. There you go. A little bit more common. There's just one at the open there though. Oh, even with two, no, there might be, maybe I need to do it something a little, I need to change some things to make it show up more in, to make it work for treasuries more. It was really, I never used it on treasuries. I only used it on the S&P 500. Because I'm looking. So the problem that you're seeing is that it has to be more than just a pull price. Like, actually, I should go back and look at the code for that. But if you were to go back to like tick data, like 1 tick data, then when you watch the data series, it'll be like, here's they're going back and forth here. And then it goes from here to here to here, all in one move. And like literally nothing traded there for it to happen. UB? Oh yeah, now you get it. You can get it to show up in UB really easily with 2,000. So for that one, we would really want to go way down, like 100 maybe. What if I just set it at 0? Only one with 0. 5? Yeah, sure. The thing is in these markets, there's like a robot that will always take a fill there. So like it's pretty rare for the 10-year to tick through without at least 1,000 trading there, right? Anyways, doing it as a gap, it's not very effective in the treasury, but the indicator, it's not very effective in the treasury. But you can still see them in the treasury. You look for something, you just watch for it on the DOM. Watch for a bunch of volume trades there, and then they can barely put up even 400 lots on offer. And it will just trade up, and it will trade down and trade up. There might be iceberging and stuff, but like they literally never want to put more than 400 contracts at their price, a liquidity hole. So, Uzi, did you check out the Reddit anti-work debacle yesterday? Did you guys see that? Oh my gosh. That Reddit mod going on Fox News is something he'll regret forever. Dude, that guy should be on suicide watch, in all seriousness. He is not he does not have very good mental health to begin with, and I don't see how you deal with a situation like that, and he should be on suicide watch. All Reddit mods should be on suicide watch. Anyways, wait, let's answer YouTube Finance's question first before we go into this. Can you predict liquidity holes? I think it's possible, yes. Because again, one of the things that can cause a liquidity, there's two kinds of things that will kind of cause them. One will be price just starting to move so quickly that the order book just literally can't keep up. So as soon as it turns into the market maker just is like, nope, I'm not doing this anymore. That's like the point at which like the liquidity hole forms and they get pulled back from it. This is again why when we see big news, it's really common to see big move and then them completely retrace it, right? Because they form a huge liquidity hole behind themselves. When the market maker doesn't keep up with the movement and they don't start putting stacking the liquidity behind it, that's when you'll get them. But the other thing that can cause them is just like a really large transaction. If a lot of people participate in a certain area very quickly, then it can form a liquidity hole. So you may potentially be able to identify an area that, for whatever reason, because there was like significant news and there was like a significance behind it in the past, that when they come back to it, that there might be a lot of people interested in trading there and a lot of people are going to trade there. Because essentially what happens is there's so many people that are out there looking to trade. And if everybody that's out there looking to trade has all taken an entry in that location, then there's nobody else to transact and there's nobody else to put liquidity there. So again, you get a liquidity hole because everybody's already traded the volume that they wanted, right? So you could potentially predict it. Can you tell us more about the GDP numbers? I don't know what to say. It was 6.9% versus 5.3 was the prediction. The S&P 500 does appear to like it, at least a little bit. The treasuries did not react to it very strongly. I think that the treasuries were more interested in the PCE price index, or not that one. The, what was it? Advanced GDP price index, These are US PCE prices advanced. Yeah. That's an important number, just to note. We get some important numbers tomorrow too. Personal income, personal spending, course, PCE. This is like the Federal Reserve's preferred measures of inflation. So that's because, again, what the Fed was saying yesterday was, well, we have set ourselves up so that we can start raising interest rates, but we're data dependent. And if there's a slowdown between now and March, then we're not going to raise interest rates because we don't have to. But if we continue to see high levels of inflation and we continue to see the economy and employment do well, then they're going to raise interest rates, right? You don't want to say it out loud, but you chuckle because you know, right, that all Reddit mods should be on. Well, I mean, I don't know all Reddit mods, but here is the problem with Reddit. This is 100% the problem on Reddit. Anybody can go and start a subreddit, and you can be the owner of an extremely large subreddit simply by virtue of the fact that you were the first person to think to go and make it, right? And then you go and you say, I need moderators. And so what do? You just take anybody that's willing to do it. It used to be, back in my day, you were on a forum. To have a big forum, first of all, you had to be a really good forum. And you had to be a really good moderator. And to become a moderator on the forum, it was a big matter of prestige. You had to be posting a lot and people knew who you were and liked you, and then you could become a mod, And it was a big deal to become a mod. Not very many people did it. On Reddit, any guy can become a mod. And apparently, well, not apparently, but that the people that are going to want to become mods in that kind of a situation are not going to be the people that you want to do it. And so what you end up with is these big, wide subreddits like r/news being run by complete lunatics. And so what happened here, if you're not familiar with what we're talking about with anti-work, there is a subreddit on Reddit called r/anti-work. I always call it r/ because that's how you get to it. You go reddit.com/r/anti-work. Right? And this is a group of people that think that there is a problem with work. And it's actually really two groups of people. I have to say, for you conservatives out there, of which I am a conservative, do not sleep on this. To come in and say, well, anti-work is now dead, it's not a problem, and then just ignore it and move on, this will kill you. Okay? If this problem continues to be allowed, it will destroy Republican Party. Okay? What are we talking about? So there's two groups here. One group of people are old millennials that just are lazy and had everything handed to them, and they don't want to work. And there was definitely a lot of those people on r/anti-work, and they're thinking, why do I have to spend 40 hours a week in order to even survive? They think that things should be, modified, like part of it is one group of it is just work week shouldn't be 40 weeks. We should have 30-hour work weeks now. Everybody should work 30 hours. That should be the standard. And with less people working, the pay rate that you get will rise. And so people will be able to maintain the lifestyle, but they'll have more free time to do what they want. Hey, listen, I sympathize with this to some extent, because I do feel like that that sometimes when I'm working, it is we are just bone to the grindstone sort of a thing, or we're just pushing as hard as we can to get the thing done because we have something to do and we're into it and we enjoy doing it, right? But then sometimes you're sitting there waiting for somebody to do some review or to get back to you on some issue, and it's or you have to wait for the next day for them to have the meeting or whatever, and it's you know what, you don't spend the whole 40 hours there doing pure work. Usually not. And so, hey, why not let people not be at work and have less hours, and you might still be able to get some productivity. And there are actually some countries kind of experimenting with this sort of stuff. Or having 3 days off. They have a 4-day work week, for instance, right? Okay. So that's what. So those are two kind of groups, right? There's ones that are just lazy. There's the ones that kind of think that we should be able to work less. These are also the same people that think that there should be like basic minimum income, right? Okay. And then there is the work reform crowd. The work reform crowd says that companies across the United States are using all sorts of HR tactics and union busting tactics to essentially pay workers less than they are worth. And you know what? They're right. They're right. I don't think that unions are necessarily the answer. I mean, not in their current form, because, man, unions kind of become their own interest group in and of themselves that cause more problems than they solve, unfortunately. And they start taking a bunch of your pay. I don't know what the solution is there, but hey, maybe there needs to be union reform. But then there's this other side, like my wife. She is a flight attendant, okay? She's been working there for a very long time, probably a lot longer than she should. But you build up the seniority and you get the schedule that you want. And so, it's kind of hard to leave, because then you won't be able to get the schedule that you want, and especially if you have kids. So it's kind of hard to leave your job. But they haven't been giving pay raises more than like 1% over there for years and years and years. And so the result is that these flight attendants aren't making very much. And then on top of that, the flight attendants that are new make like literally nothing, because the problem is that there is a law. This law was implemented for trains. So this was like way before airplanes and all this sort of stuff. But when it was trains, the rule was that the people that were working on the train, they weren't actually working until the train started moving. Okay. So for the airlines, it's like when the door is closed and the plane is moving, then you're on the clock. Okay. But if you're taking a flight that is only like a 30-minute flight between Salt Lake and Denver, then you're right. That's only like 30 minutes. But that doesn't factor in the fact that you have to drive into work for 30 minutes, and you have to wait for the plane for 30 minutes. And then you have to wait for the layover time, which might be like 4 hours before your next flight. And so here you go. You're only getting paid for an hour's worth of work, but it was your whole day. It took up your whole day to do, and you only got an hour's worth of work. And so there are flight attendants out there that are first-year flight attendants. They literally make $15,000 in a whole year, and they're like working full-time. No joke. Can you believe that? It's absolute. And like I said, my wife, she should make more than she does. If she works hard, she can make like 30,000, but she's been doing it forever, and she's really good at it. And she's got you would think that she'd be able to get up to like 40, 50,000. Nope. Flight attendants are some of the most exploited workers in the United States. And the thing is that everybody thinks it used to be a prestigious position. Like back in the 50s, like being a flight attendant was a great gig. Being a pilot is still a great gig, because it's really hard to get pilots. But they'll lure these girls in and tell them, it's like all great. And then they're like just outright lying to them. They're just like outright lying to them. It's crazy. So should there be work reform in the United States? Yeah, I think so. I think that Republicans are going to really damage themselves if they use this and they say, well, we don't need to change any of those things, because there are lower class workers out there in the United States that are really hurting right now, right? But to r/anti-work, the thing is that this was a subreddit that was basically started by anarcho-communists. They basically, they don't think that they should have to work if they don't want to. It's what they think. They think that if there's no government but there's anarcho-communism, that they can just chill all day. This Redditor, he wanted to teach philosophy. Okay, so anyways, here's what happened. This guy, he owns the subreddit. Like, he literally, I don't think that he created it, but the original creator of the subreddit disappeared, and he was like the next mod in line. So he becomes the top mod, and so he has the ability to remove all of the other mods or do whatever he wants. He has complete power there, right? And because he was the top mod, he was approached by Fox News to do an interview. Now, in the past, the r/anti-work subreddit has been very anti let's do an interview, because they think of it as a movement, and they talk about it, and they talk about what can we do for our movement, and it's like a whole political thing, right? And they said, no, we shouldn't do interviews because they'll try and make us look dumb. Okay. So they voted and they said, no, don't do an interview. But this guy, he was top mod. He said, I'm going to do it. And are you okay with the other mods? And of course the mods were like, well, you'll remove me if I say anything bad about you. So of course I'm going to say yes, whatever you say, old great one. So he went and he did this Fox interview, and you can watch it online. Oh my gosh. It is so effing funny. So like for starters, this guy is autistic. So they're doing the interview with this guy. He cannot sit still. He's going like this the whole time with his chair, rocking back and forth in his chair. And he doesn't have a good camera or lighting or anything like that. So the feed just looks absolutely terrible. And the room is just his bedroom, and there's like clothes everywhere in the background and stuff. So like right off the bat, not basically presenting the exact picture that everybody thinks of anti-work. Because again, like there are some like legitimate issues here, but the reality is that most of the posts there were like just absolute lunacy.
0.08%
just
in January 26th,
communists
0.08%
with
January 25th.
no grip on reality whatsoever, right? And this mod was probably like a big part of it, because people would say certain things. They would be like, well, we need to do this, we need to do that. And be like, no, we need to, you know, he would slam them down, and he was very forceful in the thread, you know? And so they get going into it, and they're like, so wait, do you work? How much do you work? And it turns out that this guy is a dog walker. He's a dog walker. He works less than 30 hours a week, and he would like to work less. What? Like, this guy is like absolutely nuts, absolutely crazy. Like that's just like that right there. Like when you watch it, you just start laughing. Like at first I was like, well, this guy just kind of seems kind of dumb, but like it started getting funny. And then he was like, what do you want to do with like that extra time? And the guy said he wanted to teach philosophy. It's like, you can be serious. You think that you're going to teach philosophy? Like, come on, man. He just does not have a grip on reality. But like so then afterwards, like going into it, turns out that he is like a non-binary, transgender, all of the things that people say about Redditors, and autistic and all of these other things. So it's like, really is like, this guy who was very mentally ill was in charge of the subreddit, got called in to do an interview, and completely embarrassed himself in the whole movement, right? But that's not where it ends, man. That's not the entertaining part. Because after that interview, Reddit, just the biggest, what is the word that we're calling? What is the word that we call this for this instance of episode? The largest episode of subreddit drama I think that Reddit may ever have. So there was a huge thread, people criticizing the guy and being really mad at him for doing the interview when they said that they didn't want to do the interview. And he was defending himself and making himself look really, really stupid with all of his posts. It was kind of like self-defeatism sort of stuff. Like, well, everybody hates me anyways, so what does it matter what I say, sort of a thing. And then he closed the subreddit. He just straight up closed the subreddit, made it private. And man, and then they posted, so the refugees went to r/work reform, which is where I'm like, oh, okay, like there does need to be some reforms for work. Like in the flight attendant industry, there's this law that makes them only paid when the doors are closed instead of the amount of time that they're actually working. And I think they should change that. I think that Congress should change that. That's a law that Congress should change. And hey, here's where there could be a movement to change those laws, because nobody ever talks about it. So maybe work reform is a little bit better. So the guy that was the mod of anti-work posted in there saying, I just closed it until this drama all blows over, and then we'll bring it back. And the moderators of work reform banned him. So and so if you want to entertain, if you want some entertainment, there's a subreddit called subreddit drama. So go to the subreddit drama subreddit and read the super thread that they have about it there. It is crazy stuff. It is crazy stuff. Movements always become about the movements taking the change they want and putting it on a back burner, because if they get what they want, there can be no movement. Maybe. Listen, like the thing that drives me crazy is that if you and a group of voters have an issue and you have a good point and you start making your push to legislators and stuff, like they're people and they want to help. Like the one of the problems I think is that everybody thinks that it's like corruption. It's like these people are just really evil people and they're doing everything they can to hurt you and this and that and the other. It's really not like that. It's really more like that the incentives and everything are kind of tilted against the average everyday man. And so the congressperson, they think of themselves as a good person, and they're trying to do everything right for their constituents. But the way that the system is set up, it kind of sets them up for failure. It kind of leads them towards the wrong thing. But the good thing about it is that if you have a good issue, you can get through to them. You can get a group of voters and you can write a letter and you can say, this is the legislation that we should have. Flight attendants should not be paid based on when the plane is moving. They should be paid based on how long they are at work on the clock, right? If I have to be there by a certain time, I start getting paid by that certain time. That's what makes sense, because it's not fair for them to be working literally full-time hours and not be getting full-time pay. It's wrong, right? You get a group of people together and you start talking to the senators that would be partial to this kind of an idea. They listen. You can get through. I'm telling you guys, you would be surprised. You would be surprised if you have a good point, how easy it is to get through to lawmakers. It's actually insane how connected our congressmen can be with regular people. It's just that most of the time they don't do that thing because the incentives are tilted against you, right? They go with what the corporation says, because then the corporation comes in and say, well, yeah, but this, that, and the other thing. If we have to pay flight attendants more money, then how will we be able to compete? Well, yeah, it's going to hurt your stock price probably. Probably is going to hurt your stock price, but you won't go out of business. What else are you saying? The idea that they're this class of nobility that just wants a fair shake is a little bit legitimate farce. You go to a 4-day work week, for example, the lower class workers still call out 50%. Well, there's when you get into lower class workers, that's a whole different bag, because there's a lot of people that are like just kids, you know. They're kids that haven't gone to school or haven't figured out where they can make the most yet, right? And they're just at the easiest job that they can get. But then there are other people that like that's what they want to do, or that's what they're good at, or that's that they're not super smart or anything, and that's the best that they can do, and they don't get paid. There are some people out there that work super, super hard and make jack squat. It's really crazy. Well, it's true that the young middle class have no healthy financial outlook at the moment. That's partly because wages are not yet aligned with current financial crisis climate. Yeah. Employees get $1,000 bonuses to clean houses, and the following week never falls. 50% callouts. I bet, yeah. And that's where it's like for the people that work for you, I highly doubt that very many of them think that that's what they're going to do for the rest of their life, right? If that is what they want to do for the rest of their life, they're probably going to break off and start their own company at some point, right? Well, treasuries are kind of on the downturn here. It's kind of been a little bit of a slow move. S&P 500 looking pretty good at the moment. At least they're recovering a large portion of the sell from yesterday. Half of our staff has been with us for over 10 years. No, the position that I have in ZN is a sim position that I've had on since December. So this is Seth's CTA experiment. And I haven't had to do very much with it lately because I have to be at least one contract short. And right now I don't want to be more short because I'm not so sure that interest rates are going to rise much more than they have. So I'm just kind of chilling here with this one. Yeah, it's a swing. So here's what really happened. Here's what really happened. I wanted to be long interest rates over here, and I go long interest rates and it comes back on me, or maybe I lost money on it or whatever. I'm like, this is a trade where I can get in and I could probably hold it until like March, right? Like I knew. But I just couldn't hold it. Like no matter what I did with the risk parameters and everything else, I just couldn't hold it. So I said, okay, like this isn't working over here. Let's just put a sim position on and let it come against us. And that's what I did. I let it come against us. Before this was in profit, I think it went like $2,000 against us. So it was kind of the thing was like, I knew that I had an informational inefficiency in that situation, but I couldn't figure out how to find the situation where the market was going to come along with me and was going to see that inefficiency playing out, right? Or rather, where was the flow going to come from that was going to bring the market back in line? And I didn't know when it was going to come, so I said, let's swing it. And it ended up coming in January, so. Did you profit? I didn't take any trades yesterday. On the now funny thing, in MES rather, I took a sim trade, and that one went almost $5,000 against me, I think, and then came back and we scratched it. We made 200 on it. So that was kind of dumb, but I was, we were just screwing around. I don't really like trading in that kind of action because you get those sorts of things. You get a lot of really crazy moves that are often don't really make sense. Like, I'm sure that to the people that were trading that yesterday, they're like, oh, the Federal Reserve is being mean. That means that we should sell it. But when you really look at the economy and everything that Powell said was exactly what he should. I don't know what you would say otherwise. You know what I mean? You had the best day ever? Well, you must have gone short the ES then, huh? I don't know. Like those ones, I think they're a crapshoot. Like you can make a ton of money on them, don't get me wrong, but you can lose a ton of money on them too, right? So you would if you made money on that, my advice to you would be consider yourself lucky and run, right? What is oh, I don't have it over here. Ferengi rules of acquisition. We don't know what number 1 is, I think, but number 5, like the first one in the book. Once you have their money, don't give it back. Huh? Maybe you really knew what was going on. Maybe you had a good signal. Maybe you were lucky. Either way, don't give it back. Okay. You fire an employee for drinking on the job. She starts her own business and screws it up in a few months because she feels she can drink on the job because she works for herself. True story. What? IK, I'm not sure I know who you are. Or are you just saying that, yeah, maybe I was lucky and I'm a degenerate gambler? I was going through the other day. I made an influencer tier list, a finance influencer tier list. I didn't put any of the futures trading influencers on it because I was like, I'll be too nice to them. Let's go to be every. Oh, it's Yoda. Oh, okay. You did make money. I saw you talking about that in Discord. Yeah. Anyways, I was like, where do I fit on this chart? Degenerate gambler, 100%, 100%. Even though what I push here is informed trading, and I think that there's significant edge to be found from informed trading. I think that when you're trading futures as a retail investor, there's just no way around it. What you do involves substantial risk of loss. And when you make money, taking on risk is a big part of why, even if you're adding other edges on top of it. If you really are going for the not taking on very much risk at all sort of a thing, like you have to do arbitrage, you have to be fast to make those ones. So the reality is that if you're trading futures, you're a degenerate gambler to some degree. To some degree. Dave Velke says I'm a degenerate. Just I think that once we accept that point, I think that was another one of the changes that I kind of made more recently was kind of accepting that what we do is degenerate gambling. I'm not going to say that it's going to help you and it's going to make you a better or worse trader and that it's going to help your psychology or anything like that, but you will probably enjoy what you're doing a lot more if you accept that. Yeah, I tell you what, I've made some big money on FOMC days and I've lost some big money on FOMC days. And right now I am just feeling very risk averse. I don't really want, you can see me here. I mean, I could have tried taking a trade today, but I don't see a reason for it to do anything yet. So I'm just kind of sitting here. We're going to see what the S&P 500 does. They retraced that gap really, really well. They retraced. I can't see it on my 5-minute chart very well because of all those little things. Something like 39.40 would be great. Oh, no. 43.85. 43.85. That's what I was looking for. 43.80, 43.85, something like that. That would probably be the point at which we'll start getting pushback in sellers in the ES. The things I say and confess to in Discord really shock the noobs. I probably risk too much. I'm going to hammer the sell button if it breaks down. You know what? If the S&P 500 like really falls apart here today, that would be a really bad omen, right? Like you had a pretty ugly week to begin with. Had the FOMC, really shouldn't be anything from the FOMC. Maybe it's probably an overreaction, but then the next days they follow through with it. That's not a good look, right? That's gonna really hamper sentiment at the very least. We've been selling this whole month. Yeah, that's one of the things I've noticed is that I really have a tendency. Well, at first it was intentional. If I'm going to do something in the yes, it has to be a buy. Because that was the environment that we're in. Now we're in a different environment. Now I think it's a habit. Like if I look for a trade, it's almost always a buy in the ES. I think part of the problem is that the market is trading like this is doom and we're about to go into a recession, and I'm just like, I think things are fine right now. I mean, I seem like I'm in a pretty good mood, right? Although I have to say, yesterday, I tell you what, I go through some really bizarre episodes. I don't know if it's something that I should be concerned about or not. Ayo, hey, how are you doing? So like yesterday, had the FOMC. If I had just taken the loss and the negative 5,000 and it hadn't recovered, then I probably would feel pretty nasty. But because even if it's a sim trade and even if I'm just screwing around, the loss still feels bad. But I'm feeling pretty good, and I'm feeling pretty good because there's some good news and the market recap that I posted. I don't know if you guys are watching the market recaps I post every day on Shorts. It should show up in your feed, so I would appreciate it if you watch them and give them likes and comment on them. I think they're hilarious. I don't know. You tell me. When I make those things, I am laughing. I think it's so effing funny. Especially yesterday with the Kathy Wood and then Jim Cramer. Old pictures of Jim Cramer are just like, man, like there's nothing wrong with having the curly hair look and all of that sort of thing. A lot of Orthodox Jews do that and totally rock it, but on Jim Cramer, he looks better bald, right? It was just so funny. I post it and it gets the same amount of likes that like all my other TikToks get, but the algorithm didn't want to show it. Really disappointing, because I was hoping that I would continue to get 10,000 10,000 views on those shorts, because everybody seems to like all the comments that I got are like, I'm subscribing for this, keep doing this, I love this, yada, yada, yada. But then TikTok doesn't send them back. What the heck, TikTok? And then YouTube doesn't really show them to that many people. Doesn't seem to take off on YouTube. Although I hear that on YouTube, like, you can post a short and then it takes off like 2 weeks later or something like that. So I don't know. We'll see what happens. I think they're hilarious. And I thought maybe by this point on TikTok, we would have more subscribers on TikTok than YouTube, but no. So I'm sitting there doing my workout and it's cold out there too, right? I really hate how cold it is right now. So that got me down. I was feeling pretty disappointed and like, put in so much work. Like I'm like working 2 full-time jobs between the stream and my regular job, it feels like sometimes. And then nothing to show from it. Excuse me, I choked on my own spit there. It's like nothing to show from it. All of that work and it's still this tiny channel. And the YouTube, the algorithms like never give me my due for whatever reason. It's so frustrating. Because I think the content is great and I'm doing everything that I'm supposed to. I'm just like, what am I doing wrong? Am I just wasting my time? Or, And then I get done with my workout and I eat and I'm just fine and I didn't even think about it. And that could have been something that, when I get into that kind of mood before, with my ADHD, like, it can be like that for a week or two, right? But I just bounce right back out of it. And I don't know if that's like what a normal person does or if I'm like suppressing my emotions and this is like unhealthy or what, but I just bounce right out of it and it's fine. So maybe I'm too positive. I don't know. I'll look at this market. Obviously, there's some valuations out there that are a little silly, right? Like for instance, yesterday, Tesla beat all of their numbers. Forward guidance wasn't the greatest. They came back, and you know why? Because the valuation on Tesla is crazy. So, yeah, there's gonna have some of these companies are gonna have to come back. They're gonna have to come back, but that doesn't mean that we're gonna go into a recession or that the stock market is going to be down forever. And we're never going to make a new all-time high. It probably means that we get a 10 to 20% pullback, and then next year will be a new high when the economy continues to grow, because I don't think we're going into recession yet. I can change very quickly on that. Would only take a few data points for me to be like, oh no, yeah, we are going through a recession. Initial impulse in ES looks positive. I'm gonna wait for the sellers to give their try though. So I don't know, but that has led me to always trying to buy the ES and then getting screwed. I was just thinking there may be 1.83. You notice I really like those even numbers in the micro treasuries, but they already just moved down 4 ticks, so it's already too late. I had thought it would, by the time it had crossed on my mind, we were already 1 tick through, and so I would have had to have done it with the limit order. You're expecting a drop? Why? I mean, that sounds like a good. It sounds like it might be a good trade, but I need to know why. What's the flow that we're expecting to see that will create selling in the S&P 500? I want to know. The flow that I see in the treasuries that might bring interest rates down is that they just moved too far yesterday on nothing. That's all liquidity. Well, that's not going to cause it. No, that's not how it works. It's not how it works. I can't believe the ES is 120 points above. Well, I can't believe that the S&P 500 dropped 100 points yesterday anyways. So I just really think that it was just a big nothing burger. I don't know, man. We sure missed a good trade there in the treasury. Maybe I should just go with it right now. I don't know. Coming back over here and looking at the profile, like, I don't know. They haven't broken the overnight high yet though, so I think we could, if we're gonna get a move, we could still have some opportunity. I can try and wait for a place it's better for us to be able to wrangle a position, maybe. Oh, that sure isn't giving me anything.
Aramco CEO NASA says the demand for conventional energy is likely to prevail for quite some time while supply is discouraged and alternatives are not yet ready.
By the way, yesterday, after the Federal Reserve, Bitcoin took a dump, but then this morning they're looking pretty good. Gold back to 1800 and oil at $88. Oil looks great. Maybe I picked the wrong date for those options. Maybe I should have gone even further out.
Aramco CEO NASA says the investment in both existing and new energy should
In the
be
long run, it
continued
could hit
until the latter is
4,800.
developed enough to be able to meet rising global energy consumption.
I think once retail buyers get out of the way, it could fall. I don't know if retail's gonna buy though. Well, so when I'm thinking about the retail day trader, they're always gonna want to go with the trend, and because yesterday was a sell, they're gonna be thinking here in the morning, I want to sell it. Right? Even though it probably doesn't really mean anything. There's your 10 points right there. So why is it that I always seem to have an inkling that it's going to move, but that I don't know necessarily always take it? What's with that? I'm beginning to not trust that. Yeah, you shouldn't. It's almost all fake. How many times could they raise interest rates? Well, the market is currently pricing that they could raise it 5 times. So before they were like going between 3 and 4, and now all of a sudden they're starting to maybe price in 5, which is pretty wow, right? Part of why this is getting hard to get any kind of a reasonable position here is because the 30-year was really pushing. So there is, look at that volume at 19.5. Okay, so there was a slip right there. At 85, huh? Yeah. I'm not quite sure what to think of that. Well, that probably means that we might just, the first little bit of the ES might be choppy, or it might be a sell. And it doesn't look like the buyers are coming through here. And there's another 5. Hopefully they come back for us here. I could put one right
Biden
there.
says job growth shows the economic plan is working, and I urge Congress to pass legislation to make the U.S. more competitive.
It's insane how a few stocks have a huge weighting on. Yeah, it is. How did we get to this point, huh? Maybe that was just always going to be the inevitable results of, you know, the importance that we put on indexes now. I don't think that that can go on forever. I mean, I don't know how it happens, but I'm pretty sure that if everybody says that the best way to invest is just to put it in an index fund, at some point it's not going to work well. Some point it's going to screw you over, because that's just the way the market is. Dow index is price weighted. Well, the thing is the Dow index doesn't have as many of those high growth stocks that end up dominating everything. It grows so large. That's the real problem, is that you go in and everything is equally weighted, and then Google goes up 20%, and now it's like half the index. It's retarded. I didn't know that they were weighted differently necessarily. Tesla's negative 5% right now. That compared to yesterday's close. The way that Tesla goes here could be really useful, huh? Ron DeSantis pulls even with Joe Biden in the 2024 prediction market? Really? I want to go check that now. Let's go to Predict It and see what they've got. Harris, the 47th president of the U.S. 31% yes. Okay. Okay, here we go. 2024 election winner. Oh, that's funny. So they got 29% think it will be Donald Trump, 24% Joe Biden, and 23% for Ron DeSantis. With Pete Buttigieg pulling up the rear at 6%. Man, no, Phil. I'm feeling a little frustrated here. I kind of feel like it's now to the point where it's like if I just bought into it, I would just be, it'll just come back on me, you know? YM or MYM seems more predictable. And I don't think it's, I think that there's still, I kind of wonder about Pete Buttigieg because I kind of feel like he was set up to fail. You know? I don't know. I kind of feel like that he was a strong looking candidate in the Democrat primary and that he was kind of set up to fail. Like they put him out to pasture with the hope that he would go away. Because, like, if Joe Biden doesn't run again in 2024, which he said he's not going to do, but if that's what happened, wouldn't Buttigieg be like at the top of the list then? I don't know. 95. It's looking good now in ES. Oh yeah, I'll take that. Netflix after the news 6.1. Oh yeah, because I forget who it was. A famous person said that they bought Netflix. I don't get the Netflix one, to be honest with you. So first of all, their subscriber growth isn't growing as high. Here's the problem with Netflix. They put so much effort into creating that content. It was a lot of investment for them to create content, you know, to have their own shows and stuff. And what have they gotten out of it? Right? Like they got Squid Game, which was a cheap show produced in South Korea anyways. Right? And so they didn't really get very many good properties out of it in the end. And they didn't build their business. They only have one business, streaming. They haven't expanded their businesses into other things, maybe. Like maybe they could have started making video games. That could have been a spot. I don't know. Like they could have done things. So I don't see, and Netflix is in the end a growth stock. So I don't see the reason to be in it. I don't see the reason to be in it. But a lot of the big funds still seem to really like them. Them and Facebook is the other one. It's like I don't get the Facebook thing. All of these funds think that Facebook is like the most undervalued tech stock. And I'm like, why would you want to be in Facebook right now? Everybody hates Facebook. Democrats hate Facebook. Republicans hate Facebook. I don't know why you would want to own it. I've heard it's in a bubble now. You talk when meaning Netflix? Yes, it was Bill Ackman. Yes, that's right. That's who it was. Wouldn't that be great to just be able to say, hey, I'm in a stock and it pop for you this week? Good. This is a good trade in, yes. Now we got to manage it right. Yeah. How should we manage this? I have 2 contracts on. I did take 1 off. We should take 2 off if we can. Missed multiple entries on this rally. On ES or in ZB? So I missed multiple entries in ZB for sure. The treasuries sure have been leaving me in the dust lately, haven't they? I just need to be more aggressive, I guess. Mention closer and closer to being able. Are you still buying ATT then? I don't know, man. I do like AT&T. I've been thinking about bailing on my losers and just going into something else. I know. I still really believe in Sumo Logic. I still really like that company, but the other one, the Zillow one, that was a dumb move for me. That was a dumb trade. Not a trade, it was an investment. It was dumb in the end. So I'm like, should I just cut my losses? So the thing is you can get out anytime you want and just invest in something else. So like the question is, you know, yeah, maybe Zillow comes back eventually. Eventually they could come back, yeah. But there's something else better growth. But I'm not sure if that's AT&T, you know? That's the other thing is even though I might think that AT&T might be an okay one, I don't know if that's the best growth that I can get from my money, you know? Oh, it never really correlates with the rest of your portfolio. That's good. Yeah, I'm having kind of a hard time trying to figure out how to balance things because right now they're pretty balanced, but it's because I've got like one big position balanced against some high beta positions. Treasuries, I tell you what, they came up there. There a lot of volume traded in here, so that's why I was kind of like wary of touching it. Now they're just resting there. It's just they went to those prices. Market makers are holding it, and nothing's happening now. Market's getting close to red. What do you mean by that? I baked in so much profit into that original trade that in the ES that I can literally just hold it all day. Look at that. Should we fade this? What, in the treasury? In the ES? I'm trying to figure out what it was. What was it that I said that makes Lucas think that I'm saying fade it? I don't like the idea of fighting any of these trends. I think that that this treasury might have to come back a little bit, but then that might just be a second entry for all I know. Everything is going up. Yeah, well, maybe yesterday was silly. I don't know where at which point does what point does the bullishness in ES become silly? Yesterday's high 44.45, that's way up there, but this is kind of like just kind of the Federal Reserve prices, you know, where we were at before the Fed release. So I don't know. 44.15 might be a good place for me to take my third contract off and just get $200 off of it off of 3 contracts wouldn't be bad.
Homes index previous 122.4.
You know, thinking the sell-off might resume at some point, it could. Oh, well, here's the problem I see with the sell-off resuming kind of
Commerce
theory.
Secretary Raimondo
The sell-off has been driven largely by higher interest rates, and today the interest rate is dropping.
Some relief. This is coming from an MSNBC interview.
Today the interest rate is dropping. They're an iceberg? No, okay. I was starting to get a little concerned about an iceberg there. So they're at 44.15. You saw they went and they traded it pretty lackadaisically. Well, I think there could be a lot more in this, but um part of it is just that I feel like I've tried to let them run in ES too much. I don't know if I really have a very good edge in knowing how far this will go in ES. So that's kind of problem number one. Problem number two is that I'm still kind of interested in trying to trade the treasury here. What do you mean interest rates are dropping? Well, they're before at the beginning of the session, we were at 1.840 and now we're at 1.807. So we have declined 4 basis points in the 10-year yields. That's what I mean by interest rates are dropping. Still higher than they were yesterday, right? I think that's higher than they were yesterday. Like, they are just not giving it any rest here in the treasury. This is an insane trend. We've seen so many insanely strong trends in the treasury. Do I just need to start hitting into them? But I know that as soon as I do it, that it's going to stop there. I just don't like this spot. I'm too battered, the folks. That's my problem. I have too many memories of, oh yeah, here's a good trend. I get into it and then that's the end of it. That I'm like afraid to do anything now, and then it just keeps going and going and going. And yet we barely broke the highs in the fight. Listen, it's just on a relative basis that the movement direction in the treasuries, they are buying this. The trend this morning has been a buy. Okay. So if you're looking at the correlations, if this is buying up, then you should see the mini buy up too. Easier conditions, good for the indexes. Strong algos pushing it. Oh, somebody's buying this. This is a big meta order that's coming through here. Like, that's the thing that's surprising here. We're seeing a large meta order. They only let it rest for 10 minutes and now we're seeing another leg. That's a little unusual. Wouldn't be surprised if I wouldn't be surprised either if it ended up in the red. But when we started this, I said I wouldn't be surprised if they retrace yesterday's move, right? Because again, I do not see any informational content behind yesterday's move. I really don't. Chairman Powell didn't say anything that I wouldn't have expected him to say. I think that sometimes traders will latch on to one teeny tiny little thing and trade it on that day and make money and think that they're geniuses, but like those things never holds. Like, the market moves very far away from where the FOMC is very quickly, and it turns out that everything that we had placed up around the FOMC ends up not mattering. And we've seen that time and time and time again with FOMC meetings lately, because the Federal Reserve almost never does anything unpredictable.
-2.2%. US pending homes index previous 122.4.
I've been seeing some people trying to make the argument that the Fed should surprise the markets, and I'm actually kind of starting to like that idea. That's like, yeah, we should raise it. We should do a 50 basis point rise just because the market's not expecting it, just so that they don't think that they control us. And that would put an end to that whole mess. Hey, maybe they have a point. Anyways, The bigger idea here is I don't know if going long interest rates at this point makes sense. I'm not going to fight that meta order. No way. What's the meta order that's going to come in and push interest rates higher here? Now that we've seen the flow that I was kind of looking for, which was the retracement move. I don't know. I do see that they could go below 1.8 though. Well, the reason why I say that there's a meta order is because of the cumulative delta, right? So again, what is a large meta order? It's a big order that can't be executed all at once, and it creates a consistent flow in the market that could be explain the high degree of autocorrelation that we often see in volume. So if I see a large degree of autocorrelation, that means that they're mostly buying through this time period. That probably means that there was a meta order there. There was a meta order that pushed us up. Here was the post meta order impact right here. And now only after only 10 minutes, they're making another push. That's a little crazy. That's a little unusual. That's an unusually strong push. But that's also why I'm a little bit worried about it, because they're going into it so quickly again. I don't know if the order book is stressed, but that may be the sort of thing that kind of screws them up and causes them to stumble a little bit. Right? That's why I'm not, I'm trying to be careful about, like, if I take a trade in this, like, I really want to be getting a good price, and they're not even giving you one. Oil is dropping. Oh yeah, you're right. But you know what? The move in oil was really good. Oil being up at 87 now, that's pretty impressive. The bigger picture is they needed a short squeeze at some point daily. Well, I tell you what, I sure called that spot to get out in the ES really well, didn't I? I think that was mostly just intuition and luck. I mean, I saw some amount of profit taking in that area, and I just kind of didn't like it. And I thought, well, that's a decent enough profit, but it really came. I think that is just random dumb luck, though. How do we know it's a short squeeze and not short? I never said that it was a short squeeze. I never said that at all. I only said that
I'll be reading the US.
I think there could be some order flow coming in the opposite direction of yesterday's move, because yesterday's move just seems a little silly to me. Oh, I'm not saying you were. Okay, I'm sorry, Lucas. Everything's about me. That's all. That's what I was thinking. The whole short covering thing is a little frustrating to me, because people having to cover positions because they're losing money on them. That sounds like one of the best bets that you're ever possibly going to have to predict future orders, right? But
10 seconds.
How do you predict them? How do you know that this move is covering or not?
Minus 3.8%.
They've been filling the shoes of aces late, not to somebody not agreeable.
US pending homes index 117.7, 100.
Well, it's you haven't been like incredibly disagreeable, but you've been the skeptic on the informed trading, right? I've kind of been wondering. It's all marketing. Like, the thing is if I'm gonna sell a trading system, I'm not selling a trading system, but I like, I'm not saying, like, you buy this thing, I'm gonna teach you, and like, buy my course. not like that, but I am promoting a certain way of trading. So how do you market it? I say that the word is informed trading. That is a really concise way of expressing what we do that I think is appealing. It's informed trading, right? But sometimes I wonder, well, is that really, do people really care? Because on one hand, I should say, yes, informed trading is more effective. But on the other hand, I don't want to come in and say, if you do this, you're going to make so much money. And like, you have to, if you're going to take that approach, then you have to compete with all of these morons that really give people, false impressions about how much
So Biden
money
also
they can
hosts
actually make
Germany's
from
Chancellor
trading.
Scholz
You
at the
know?
White House on February the 7th.
So then the other one that I think about, and maybe it frankly kind of drives me crazy more, is the whole fat tails thing. It's like maybe we should be trying to help Taleb out and trying to find better ways to express to people the statistical consequences of fat tails. I think I haven't seen a real example. No, I mean this move down here, I think is a possible example. I have a very good piece of information here in this case, but the piece of information in this case is that nothing that Jerome Powell said yesterday should really have any impact on the probability of interest rates increasing or not increasing, or how many interest rate increases we'll get. He didn't give us anything. He really didn't. And all of the movement that we had yesterday is likely to be just from people wanting to trade and force trading and that sort of a thing. In fact, I think that's been the case the whole week. Okay, so that's the piece of information that we're using to say that they might be ahead of themselves and they have to come back. And then you can kind of see the order flow come in. I'm not quite sure I can put a finger on what it was that I saw, but I was looking for the buy. I kind of liked a certain spot, and it had already moved away from me when I got into that spot. I probably could have just gotten in right there. I didn't expect this to be that crazy of a trend, but I could have just taken it right there. I mean, that's the way that I say you do it. So you try and predict the flows. You look for supporting evidence in the tape of the flows, and you try and trade with it. You thought that the big players just want to flush the market? Well, how would you prove that that sort of thing even happens? You know what I mean? I'm at odds with the idea that you can't trade out of DOMs only, and that the market generated information is just not
And the
enough.
US pending home sales changed December.
I do agree with
2021.
that. You
Full
should keep an
reports
eye
are
on the
available on the
news.
Financial News
Okay.
feed if you want to have a read. Just some key highlights to go through here. Contract signings were 3.8%
How can I prove
lower
this?
in December from the prior
What would
month.
be the piece
Contract
of
signings
thing?
were down across all regions compared to the prior month and 1 year ago, and the existing home sales expected to decline by 2.8% in 2022, and home prices are expected to move higher by 5.1% due to the ongoing housing shortage.
You know, why
even as
do I have
builders
this
ramp up
going out to you
production.
guys? I need to mute him. I always forget to mute him. Okay, so the first difficulty in this is that really part of the reason we're saying this is because we've tried for a really long time and we've had a hard time figuring it out, right? So one of the things is, yeah, we were talking about this a little bit earlier, but I don't think you were here when we were discussing this, Lucas. But essentially, orders can be predicted to some degree. There's a lot more predictability in the sign of orders than one might think. So there again, if you see a buy order now, there's a 0.5% higher chance that 1,000 lots from now you will also see a buy. That's the degree of autocorrelation that you see in order flow. So order flow there's a lot of autocorrelation in order flow. But what happens is that the market makers account for it, and the prices get adjusted so that it's still largely diffusive. So you can see this situation where you see buying, you see buying, you see buying, but it's like really hard for you to still make money from the price change, right? That's why I think that you kind of have to predict the flow to some extent. Because by the time that it's really clear that there is truly an autocorrelation going on, at that point, the market makers are already adjusting for it. So if you can identify that a flow is going to come through and start trying to take it like as soon as there's like any evidence at all, and before it's clear that there's actually like real autocorrelation coming in, right? I think that you're much more likely to be able to catch a swing on that. So that's kind of why I think you want to do it that way. Of course, you can't trade it out of that example. You're looking at individual orders when you have to account for context. Right. s- Anyways, I was just kind of, so that was just kind of like in terms of like practical execution, why I think that you kind of have to know, you kind of have to know something first. But I would turn back to the bigger picture thing here. Because the assertion is not that you cannot make money from only watching the DOM. That's not the assertion. Which is, or if we were to say, are there purple colored swans? Okay. Talk about white swans and black swans. Okay. Black swans are these things that like you don't even know if they exist. A white swan, let's just say that a purple swan is a swan that can yield profitable trading only from market generated information. Okay. That's a purple swan. Okay. Here's the thing. Purple swans exist. Pretty sure. I've never touched a purple swan. Okay. But I've heard people talk about them. I've never seen a picture of a purple swan either, but I've heard people talk about them. And I think that there's enough evidence out there to suggest that there are purple swans. And there are, in particular, there are these guys at big banks that they regularly work with purple swans. Okay. So I'm not saying that purple swans don't exist. What I'm saying is that you are unlikely to catch a purple swan. That the algo trading firm they're out there looking for them. They are really highly value. Purple swans are very highly valued, and anytime that a purple swan is out there, those guys, those HFT firms, they immediately go out there and catch it. So for you to go and have an experience with a purple swan, if you're so lucky, you happen to be in the right spot and you end up right next to a purple swan before anybody else comes along, right? You're probably only get to play with it for a few minutes before the HFTs find out and come and capture it and take it away from you. That's what I'm saying. So it's not that it's not possible. It's that it's not the most effective use of your time. The market is more statistically efficient than it is informationally efficient. So you can spend a lifetime looking for purple swans, maybe never find one. And if you do find one, you might only be around with you for a few minutes. Whereas you can go and look for information about where all of the white swans are at, and that information is readily available. And can you, in some situations, go and get some time with the white swans before everybody else gets to them? Yes. And so that's, as a trader, that's probably a better use of your time. That's my assertion. Did my allegory make sense? So where do you disagree with that? When we make money, we are talking about consistency, and by consistency, we're not talking about making money every day. Let's say that consistency is, I don't know what consistency. What is truly realistic consistency? I know what we want. What we want is to make money every week, right? I think that's what retail traders really want. I would think you could say, hey, if you made money most of the time, you're not going to make money every year. But let's say that you make money 4 out of 5 years. That would be pretty consistent. But most retail traders, like, that's the thing, is like, if you find me a retail trader that's trading futures and has made money on it 4 years in a row, never seen it. I've never seen it. So consistency is hard. But that's where I kind of come to this other point that's like, okay, here's where you're going to have like the most opportunity to find some edge. Even then, it's still going to be crazy hard. So it may be better to think about the futures trading as a loss leader. This is a place where you learn a lot of things because it's so hard. You're going to learn a lot about markets and so forth. And if you continue to grow and give yourself opportunities to be able to take on more risk, you may eventually get into different kinds of trades. Like you'll find a stock that you know is going to take off, or a certain opportunity with options, and you make money on those. But you never would have been able to know about them if you hadn't have been doing the futures trading. You get what I mean? So even though the futures trading might not yield you profits, it may open up doors in other areas that do end up making you profits and more than make up for what you lost in futures trading. I'd argue consistency is being able to live off of it. Okay, so if we were going to say consistency would be Seth makes $5,000 a month, right? Okay. You're saying, do I understand this correctly? You're saying that you're more likely to be able to make $5,000 a month off of it if you rely purely on market generated information? Is that your position? Big Josie says consistency is important, not depending on one home run trade. Most retailers depending on home run trades. That's not good. All info is market generated. False. Jerome Powell generates some information that's not generated by the market. He'll say something that when he talks, that's generating information at that point, and that's information that the market will react to, but it was not generated by the market, right? Market generated info is only volume and price. Orders. And say orders. So we have enough information to know whether it was a market order or limit order and what price it was placed at and all that. We're breaking the rules and never say okay, but after a 5-year period of trading, you average $5,000 per month. You could live off of it. Well, for me to be able to quit my day job, I would probably need to average $5,000 per month. Yeah, sure. And why do you think that you are more likely to get that from relying purely on market generated information? because you believe it can be done, but no, I don't think that's we admitted it can be done. The question is, why are you more likely to do it from purely market generated information rather than relying purely on news? Or let's say using informed trading. Why is it that you want to do it that way? I mean, I think I know why, but I want to make sure that I understand you correctly. They did come back a little bit there in the treasury, by the way. I don't know. I kind of feel like not touching it now. Like I feel like I missed the boat in the treasury, and that at best we get a little bit of a pullback, and then it comes back. And I don't think I want to fade this. Yeah, there you go. That is what I'm saying. I don't know that, but again, I'm under the impression that your assertion is actually that you can't make it using market generated information, especially when you talk about purple swans. It seems you are arguing that yes, it can be done, but only like twice in a lifetime. Yeah. Well, and to be like let's be more specific, okay? Can it be done? Yes. Can you do it? Possibly. I don't know the strategy that you can use to do it. I've tried many different things and they didn't work. That this is the strategy that's based purely on volume and price, orders and price, and you consistently make money, consistently being $5,000 on average across 5 years, which might mean that you make $50,000 one month and lose money another month. But on average, after all of it, is $5,000 a month. I don't know the strategy that does that. I don't know the strategy that does that. If such a strategy still exists, I'm going to guess that it's well beyond my ability to find it. It's going to be something super complicated. It's going to be something that, I see. Empirical evidence tells you it can't. It's logical. I get it. Well, it doesn't. The empirical evidence doesn't tell you that it can't. Empirical evidence tells you that people don't find it, right? That's totally fair. So, so think of it from this perspective, okay? There used to not be any evidence that black swans existed, right? How many white swans do you have to find to prove that black swans don't exist? Well, the reality is that the number of white swans that you find tells you absolutely nothing about the existence of black swans, right? The only way that you can know if there's black swans or not, there's two things that you can do. One, you can find a black swan and prove that they exist, right? Or two, you can find a piece of information that would prove that black swans don't exist, right? That would have to be some sort of strange physical quality or thing in genetics that proves that it's impossible for a swan to be black, right? But of course, we never found any such thing, and instead we found that there are indeed black swans. Okay, so now let's take it back over to our allegory. We know that purple swans exist, okay? But the question is, will you be able to catch a purple swan and be able to take advantage of a purple swan for 5 years, right? And in order to prove, so again, what do we have to prove? Well, you would either one have to catch a purple swan and take advantage of him for 5 years, right? Then that would prove that you can do it, which we don't really see that in the evidence. I mean, maybe there's a person that has done it, but it's extremely rare, right? Or we get a piece of information that tells us that we're not going to be able to keep a swan for very long, right? Like that swans are very, very flighty, that other people will come along and take it away from you because they have more resources, etc., 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 right? And this is where the microstructure of the markets comes into play. Because what do we learn from the market microstructure? When you make a trade, it has an impact. Let me show you something. Can I segue into something else really brief, and then we'll come back to this? I was doing this on my Blackboard the other day, and I thought it was so cool. Okay. The change in price is equal to Y sigma, which is the volatility, times the square root of the size of the meta order over, oh, sorry, that was the wrong symbol. The size of the meta order is Q over the volume for the day. Okay. This is a well-established property of markets. The impact of large meta orders tends to follow a square root law. So the way that you implement this is you take the size of the order that you're going to trade, the amount of volume that you expect to see that day, and the volatility that you've been seeing lately, right? So you could just go and look at like the average true range or something like that, right? And then there's this Y, which is going to be different for every stock, but is amazingly consistent. Like it might change a little bit over time, but like if you measure it today and you measure it tomorrow, you're going to come to the same Y. Okay. Now you can only calculate this as if you have proprietary information. That is like somebody executed a meta order and then they showed you how they executed it, and you go and you look at the market, right? But this is the impact that large meta orders tend to have. Okay. With me so far, we've talked about this before, but if you're new, that's what the square root law of meta order impact is. Okay. Now I'm going to do something really cool. Okay. Let's say that the size of our meta order is 1% of the daily volume. Okay. So now we're going to have Y omega times, instead of Q, we're going to have V times point, how do I, times 0.01 over the volume for the day. With me so far? I've replaced that Q with V times 0.01. Okay. 1% of the volume. 1% of volume. Okay. Now V over V, that cancels out. That's 1, right? So really what you have is Y O times the square root of 0.01. Now, bonus question in the chat. Who can be the first one? What is the square root of 0.01? I'm going to show it. Let's see if any of you guys can answer it before I show you out here in the math how it comes out, right? 0.01 is the same thing as the square root of 1 over 100, right? Which is the same thing as the square root of 1 over the square root of 100. But the square root of 100 is 10, and the square root of 1 is 1. So that means that it's 1 over 10. 0.1, there you go. Ask it, got it. So Y omega times 0.1. Okay. So what does that mean? 1% of the volume is equal to 10% of the volatility, or rather 1% of the volume can be responsible for 10% of the volatility. That's what the square root law of meta order impact tells us, right? Even small meta orders have more impact than we expect. That's why it's so hard. Because I could maybe come in and like identify what is the largest meta order that we're going to see today, what's the most dominant factor in there. But there's also going to be like anybody that's even large enough to even trade at meta order ends up mattering, because if they're even 1% of the daily volume, they can be responsible again for 10% of the daily volatility. And that 10% of the daily volatility might be the size of your stop. Probably is going to be bigger than the size of your stop, right? Okay, so that's the first thing that I wanted to establish, okay? Orders have impact. So, if you and all of your buddies are trading a technical indicator, right? And there's 100 of you or whatever the deal is, what's going to happen, right? You're going to trade that trade, you're going to have an impact on the market, and you're going to move the market to where you think it's going to go, where that inefficiency is, if it's truly an inefficiency. Obviously, if you're trading against some large meta order going the other way, then you're going to lose. But if you see a piece of information that truly predicts what the future orders are going to be and tells you that price will be a certain point, and you go and you trade that, it doesn't take very many orders to eliminate that inefficiency from the market. Okay. And that is because we know that. And I mean, that is all like empirical stuff, right? We know that meta orders have impact. We can measure it. And we know that it doesn't have to be very much. So you can come in and you can use that formula. Or if it's a really small trade, you could use Kyle's formula to come in and say how much volume can actually be traded on this signal, essentially. Based on current market conditions, how much volume can the current market handle? That's all empirical, very, very quantitative and easy to prove. Okay, right? So the consequence is markets end up being very statistically efficient. So this is the strange dichotomies, right? Order flow can be very predictable, but you still have a hard time making money from it because the markets still end up being very statistically efficient. Because any kind of aberration that you might find like that, it gets arbitraged out of the markets already, and the market makers account for it and this, that, and the other. Okay. So that is the piece of information that we have that lets us know why it's so hard to catch purple swans. You see where I'm going with that? Right? We know something that tells us that trying to trade the markets with purely market generated information is extremely hard, if not impossible. Like, it's not just like we can look at the data and we can see that most retail traders fade and all of that. We actually know why it's so hard for them, because those inefficiencies get arbitraged out of the market to the point where it essentially looks like a random walk. And there's only a small number of proven market behaviors that are actually different from what a random walk is that we can find. And they're mostly in the order flow itself and not necessarily the price. Right? But we also know, because of all of that markets end up being very informationally inefficient. There can be a piece of information that we might know, and then the markets move against it anyways. And I think that what we get today is a really good example. Okay. Powell didn't say anything. Market sold off hardcore. Probably they come back just because there was no informational content behind those moves, as far as I can tell. Other than that, the market didn't like what Powell was saying, I guess. I guess you could say that that's partially an informational content about it, right? But sometimes there can be more significant things. Like we knew that the Federal Reserve was going to raise interest rates and the market didn't properly price it in until January. And we'd known about this since like August. You know, market's not informationally efficient for whatever reason. So if the market is not informationally efficient, does that mean that you can make money from trading it? Not necessarily. Not necessarily. We can take all of the empirical evidence that we have, all of the things that we know about markets, and we can try crafting a strategy to try and take advantage of that. Knowing that the basis of our strategy is based on proven market behaviors. The strategy itself is not necessarily proven, but we know at least that it's based on something that's real, right? My argument is that if you base your strategy off of something that you know is true in the markets, you stand a better chance of actually finding something. You certainly stand a better chance of finding something than you do of going and using somebody else's system. You know, going and reading a book and taking their trading strategy and trying to use it. Right? That's my argument. JP Morgan and Goldman Plus more all said buy incoming dips. It was a little bit more mixed than that, though. ARK is down today. Today's information was green, lower lows. Well, I don't like right now they're pushing the lows of the day. It's a logical argument, Lucas says, yeah. But it doesn't prove that you're going to make money from it, does it? I wish I could come in and I could say, here's a piece of information that I can guarantee you can make money off of. But I think that what the market microstructure tells us is that that's never going to be the case. That the only way that you're going to make money is by knowing something that other people don't. And if it's on the internet and it's popular, then that doesn't mean that you know something that other people don't, right? It doesn't have to be nobody else knows it, but if other people know it, it has to be a small group of people, right? And that's the thing, is I can teach you guys all of this stuff. It's whatever kind of potential edge that's out there. I don't think that it eliminates them, because I'm only telling you what the market is. It's still up to you to find a way to use that information to make a profit, right? It's still up to you to find a way to take that information and make a profit. I'm using one way of doing it, and I can't say that it's perfect, but I can say that I've been way more effective and consistent doing this than what I was doing before. I know that for certain. I have caught some really good moves that I had such a hard time getting when I was just trying to do things based off of market generated information. I find that I have an ability to know which way the meta orders are going to come in more often than not. And the problem that I have is more trying to catch them than it is, actually knowing what's going to happen. So, or minimizing the losses when your predictions are actually wrong. That's difficult too. That's probably the thing that's killing me right now. But it's a lot better than what it was, right? And I think that it's because what I'm doing is based off of real proven information about how markets behave. I hope you found that inspirational. I don't know. You might just be thinking, I don't know what Seth's talking about. Whatever. I'm just going to do my thing. So he's funny. That's all that matters. Hey, if you watch the channel because you enjoy being around or because I make funny TikToks, that's cool too. ZN dipping, you buying the dip mini traders do. Laugha. I'm thinking about it. I'm thinking 1.82 wouldn't be bad if it wasn't so late in the session. Like I usually stop trading in 20 minutes, so I don't know if that gives me a really good opportunity. I'm also like these rebounds I'm not really happy about. So for instance, did you see how as soon as the interest rates started to rise again, even though it was just kind of like, pullback, it was just kind of a pullback, but the ES dipped too with it and is pushing lows and is kind of pushing into some ugly stops there. Which type of information you think you can get edge based on? Well, the thing that I'm certain of is that informationally based edge is more available than statistically based edge. That I'm certain of. Can you truly make a living from those informational edges? I don't know. I still kind of suspect no. To be honest with you, I still kind of suspect no. Or that not very many people will. I kind of wonder if there's only so much room in the market for people that are that successful with it, and most of that room is taken up by banks and institutions. And if we want more of that space to be taken up by retail traders, we might have to change something about the structure of the markets to facilitate that. Which information is most very relevant? And let's test now. We need one variable though. That's tough. I think that we can quantitatively test those sorts of things, but I need like a feed. Like what I need is a way to go through historically and look at news events and their impact on the market. Like, okay, so like I can go through a piece of economic news and I can say, here's the impact that it has on the economy and therefore the impact that it should have on the flows that we watch, right? I can do that. And I could write that. But then there's also like every little piece of breaking news that comes out. How could that potentially impact us, right? I would have to go through every piece of news ever myself and go in and say, okay, what should the impact of that be, or what was the impact of that on the economy? And then once I've done that, then I can quantitatively go back and I can say this type of information, how much impact does it have? This type of information, how much? And ergo, which things should you pay attention to the most when you're trading, right? I will forward test for you now. Yeah. So that's where it's like I don't know. We can't test it per se. All we can do is we can come in and try and pay attention to every piece of information that we can and use our own intuition and our own knowledge of markets to determine which flows are going to be the most important that day, right? Today is kind of a special situation because it's the post FOMC day, and although we did have economic news, it didn't look like it was too significant or that the market cared about it. So this is like one of those rare situations where like the technicals of everything like matter more. Does happen from time to time. And you can kind of see how it's going out, that they went up and they tested 44.20, didn't get through it. Now they're testing the downside. And the downside area that we might be able to expect them to test is if they really continue, might be 43.40. 43.40. Now tomorrow, the thing that we're going to need to look at is the personal income and how those can potentially affect market flows. Where, and again, but here's one thing that I can say, Captain Price, is that you get a piece of information. People think that it's like you get a piece of information and you say, is this good or bad? And then you trade based off of that. Your analysis needs to be more complicated than that. Your analysis needs to be, okay, here's a piece of information. How will that affect flows into and out of different assets? Where will money move from and to because of this new piece of information? Right? Because the money doesn't just pop out of nowhere. Right? If money comes into the treasuries to sell it up or buy it up or sell it down or whatever the thing is, that money for them to carry out those transactions came from somewhere. And it probably, maybe it was money that was just sitting on the sidelines, or that is always sitting on the sidelines and it's day trading. But it's probably, if you're getting a good move, it's probably coming from another market. It's probably them taking money out of one asset and putting it into this other asset simultaneously. Right? So you want to think about, when I get a piece of news, what are that going to happen? That's why you need to watch multiple instruments. You have to consent though, or are you saying admit that the order book is a weird one because it expresses a sum of all available aggressive opinion that will not hit you small scalping stop? Yeah. Well, like that's the thing that I find really interesting about the order book is that there is a lot of information in the order book. And of course, there's a lot of data that you can just pull out of the order book. And one might ask, well, yes, but how is any of that actually useful to you? And what I find time and time again in the order book is that there can be pieces of information that can be extremely useful to your trade, but they never seem to predict what direction it's going to go or how far it's going to go. Those are the two things. What direction and how far. Something that reliably predicts one of those two things, I never find those sorts of things. In fact, it's usually the opposite. It's usually I'll find something and it will predict very effectively that it's not going to go anywhere for a while. Probably don't want to get in there. Or it will predict to you what kind of conditions you're going to see. That was what that last video was about, right? These are the kind of conditions that you're going to see. So if we have an order book that's being very dominated by market orders, then you're going to see situations where, you're going to see market orders clashing into large orders and overcoming them, and then getting ahead of themselves and pulling back because of the liquidity holes, right? So I can identify the order book condition. That doesn't tell me that it's going to go up or down from this particular point. That doesn't tell me that it's going to go this far versus this far, but it does tell me if it continues to do that, this is the way that it's going to play out. And I can try and use that to try and optimize my entry, right? Market orders are not predictive. Yep, they're not predictive. They're not predictive of direction. They're not predictive of direction or magnitude. They are predictive of future orders, though. They are predictive of future orders. Kind of the thing is that you kind of want to predict future orders before the orders come in, that enough orders come in that the market makers can make predictions based on those orders, right? The market maker can come in and can see, oh, there's a large meta order being executed along and I need to adjust my prices for that. And by that point, then it's hard to make money from it, right? But they can't predict that this guy is going to come in and trade a meta order. You haven't seen any volume from it yet, but it's going to happen. They're just the aftermath of the event that occurred in the book, yeah. But the point of that was that that's still information that can be useful to you. And that can help you say, hey, this price might be better to buy than this price. I might not know that it's going to go up or down. I might not know how far it's going to go up or down, but I can know if it's going to go up that I would rather try and put my order at this price than this price because I'm still likely to get filled, but it's a better price. Yeah. That's what I'm trying to tell you with all of the order flow stuff that I did in the order flow series. And then there's this other thing that is really just like magic, which is and we do have research to back up that you can just watch the whole order book and these neural networks can kind of find some things in it. Then I don't know how it works, and sometimes I don't know what it is that I see. And I don't know why it is that sometimes I'm like really on the ball and I can just know exactly every teeny tiny little thing that's going to happen. And sometimes I'm like dead wrong on everything. It doesn't make any sense, but it's not random. I tell you that much. It's not random. There's something there to it. Market makers having fun with stacking orders. Well, so on the Tesla thing, where Tesla goes is going to be really useful today, but Apple earnings is after market close today. So like I tell you what, if Apple earnings come out and they miss expectations and or give bad guidance, that's the end of this market. I mean, telling me about your knowledge in the book. What do you mean by that? Everything that I know about the order book, I've put into those videos. Well, everything that I can think of to say. When you worked in the Saks, the way orders are matched? Well, if you want to know the way that orders are matched, I would just go to the CME website and read their wiki. But it's not complicated. Market orders are matched in the order that they come in against limit orders that are matched based on the Q algorithm that they're using in that instrument, which is almost always first in, first out. Apple reports after the aftermarket. Apple earnings are today. So that's like another big risk event that could have a really huge impact on where the market goes from here. Because I'm not so sure that Apple's valuation is good either. I'm done speculating. Yeah. You know, another way I like to call it informed trading. But the other way of saying it is I think that there are more opportunities to be successful as a speculator than there are opportunities to be successful as a market maker. At least to be successful as a market maker on your own. I think that if you really want to be a market maker, you probably want to work for an institution. What do you mean by, are there any aberrations in the book that make it impossible to hit you stop and the machine would take about 2 minutes to find out about it? I don't know. All I can say is the further away your stop is from current price, the less likely it is to be touched. That's, I don't know what would be more than that. This whole thing, something that would tell you that we're at this price and the next price is unlikely to be touched or traded. If you get one, first of all, if you find an edge like that, it's probably going to be super teeny tiny, right? Like it's probably only going to be matter within like the next 5 seconds or something like that. And number two, if you find it, keep it to yourself, because they're gonna want. That's a good edge. That's a good edge. I hope so. So you guys have been not as many questions today on this as possible, but I really enjoyed this stream today because I felt like I was articulating the case well. Like I liked what I was saying. Did you guys? What do you guys think? Because I know it looks like a lot of you guys were just kind of following along and listening. Do you feel like you understood what I was talking about, and you understand how it can be potentially useful to you as a trader? Big Toasty says it was good, and I was like, thank you. Because this is what we're really about, right? This is what we're really about. And here's the thing. What does it mean for us, really? Because one of the things is that, hey, you might trade for a really long time and not actually get anything out of it. It does kind of say that, right? Means that trading is really, really hard. So what am I doing here, right? And the answer that I would say to you is this. You know something now about markets that most people don't know. Like, we're talking about something that like only a few hundred people on this planet understand, actually. And I think that more people need to know it, right? So you guys all, and me in particular, we all have a really important responsibility, because if markets are not very informationally efficient, that has huge consequences for society, right? I can't, every time that I see them talk anything about markets, make a change in regulations, or people talk about capitalism, like the whole conversation would change if people understood that markets are not informationally efficient. So we need to tell the world about this, right? So I'm trying to do my best by making good videos here, and there's still 2 more videos that I need to make that are going to be the ones that are going to be really like, okay, this is it. This is the video that I'm going to send to people so that they can understand the way that markets actually behave. Right? Next one is going to be empirical properties of markets, and the next one is going to be the inelastic theory of markets. Right? That, you know, and once those videos are out, we gotta get them out there. Like we gotta share this information with people. That's the one thing that I think we can take out of it. Right? I did like your math flew over my head though. Well, so here's something I'll say about the math. It is almost always intimidating at first, especially since you're often like, a lot of the time when you start to get into quantitative math, quantitative formulas, math stuff for trading, a lot of the time they're using concepts that you don't know yet, or maybe you learned in school and you forgot. So one thing is you have to go back and brush up on that thing. And the first time that you see it, it's going to be like, whoa, okay. But what you're going to find is that as we talk about it over and over, you read it over and over again, you study it over and over again, you really start to understand it, and it almost starts to become second nature to you. So if you're reading a book or you're listening to me and you see a big math formula that you don't understand, just keep reading. What I would do is just keep reading, because usually if it's a good book, they will tell you what the implications of it are. You understand the implications first. You read the whole book, and then you're going to go back and you're going to say, okay, so I remember there was this formula and I kind of had a hard time understanding that. So now I'm going to go back and I'm going to look, and there's almost always a reference that tells you what variables mean what, like the omega symbol here, this little circle with a little line coming off of it, that stands for the volatility, which is how much does it move during the time period. Okay. So that would be like the average true range would be an acceptable proxy for volatility. Okay. On a daily basis, rather. So, there you go to the back of the book, or sometimes it's in Celeb's book, it's in the front of his book. And you're going to see, okay, I didn't understand this symbol, I didn't understand this symbol. Write it down in a book, like have a notebook and write it down and say, oh, here's the formula. This variable means this variable means this. You understand that. Okay, now let's go and do the derivations or whatever math it was that they did. How does this come out to be 1% of the volume can result in 10% of the volatility? You get it. It's intimidating, more intimidating than you think. And I think that the reason it is because these guys, it's like they just live and breathe this every day, so it's like nothing to them. But you can do it. It takes work. It takes dedicated work, but there's a method to the madness, and you just understand the implications of it first, go back, understand it, and go back multiple times, and you'll eventually start to understand it. Where did you get this? Well, where I learned about the square root law of meta order impact was first from Trades, Quotes, and Prices, Markets Under the Microscope by Jean-Philippe Beauchot and a bunch of other guys. And then I started reading all of the research studies it was based off of. So I've read a lot of studies on archive.org. That's ARXIV. Well, I suppose I could have bought from 8 to 81, but 1.80 to 1.810. But, once I missed the initial trade, I really should have chased that one. But to have not lost anything is still good. To have understood what was going on in the move and that it wasn't a good spot to take it down in there was a good point. So practitioners say it's all not. Yeah, they do, Ash K. But like, I don't think that people really understand it when practitioners say it, right? So practitioners know this information, right? Like the people at the big banks really executing the big orders, they know this stuff. I don't think that they really understand the societal consequences of it, though. I think that you need somebody that you need Seth to come and explain to people why it's important. That's what I think. Maybe that's a little egotistical of me, but nobody else is going to do it. I'm going to do it. I got to get going, guys. I will see you tomorrow, Friday. What? I wouldn't sleep on Friday. Could still be there's some important data points. Could still seem some really fun stuff on Friday. So I'll see you guys then. Until then, stay profitable, friends.